Hello again, VITA volunteers. Today we are going to be discussing income schedules K-1 and rental income, and this is for the advanced certification. We will go a little into rental income, but it's important to note that for the VITA program, rental income is only in scope for those volunteers who are certified with military certification and for a very specific kind of person who is having rental income, and those would be active duty members of the military renting out their personal residence. K-1s, we do have some things that we will be able to do for our clients as advanced volunteers, but we also have a lot of areas of scope restriction along with K-1s as well. So we just need to be really aware that this is an area of tax return preparation that we need to be checking to make sure that we are staying within our scope boundaries. We're going to begin talking about K-1 income, and I'm referring to the K-1 as a form, and the reason why we're not talking about the topic, the kind of income specifically, is that K-1s can report a lot of different kinds of income. What they are is a form that is generated by a pass-through entity, and those pass-through entities could be partnerships, S corporations, or estates. A partnership files Form 1065 and would produce for their partners a Form K-1 for the 1065 that would report the income that is attributable to each partner, their share of the income. Partnerships don't actually pay their own tax, they just report the income in total and then divvy it out amongst the partners so that the partners report the income on their 1040 returns. And the way that they do this is through that Form K-1. 1120 S Corps are very similar and most often are reporting pass-through income to their shareholders. And estates also are very similar in that they they collect all the income and then divvy it out amongst those who have a share of that income, and those who have that share will report it on their 1040 returns. So with the Form K-1, because it reports so many different kinds of income, and it also reports kinds of expenses and partners' shares and shareholders' shares of various credits and other things, it's easier to have a list of the things that are in scope. And so if you get a K-1 that has anything reported on it that is not from this list, then it will be out of scope. So in the things on this list, we have interest income, dividend income, qualified dividends income, Section 199A dividends, net short-term capital gains and losses. Those get reported on Schedule D, line 5 of the 1040. Net long-term capital gains and losses that would be reported on Schedule D, line 12. Tax-exempt interest income and royalty income. And you probably recognize a lot of these different types of income that we've covered either in the basic lessons, or we've covered them in the most recent advanced lessons. And these types of income you'll be inputting into a K-1 screen for a tax layer, but they're going to end up in their respective places on the return, because the K-1 reports these different kinds of income. They are not just one blanket kind of income. So this is Form K-1, and this is specifically the Form K-1 for the 1065, the partnership return. And I just want to really point out that each type of entity has its own Form K-1. And so when you're entering into TaxSlayer, you want to make sure that you select the correct input screen to enter each K-1 into, because the boxes don't precisely line up number-wise on where you will be putting different kinds of income. And remember, we want to put the different kinds of income incorrectly so that they flow through the 1040 appropriately and they get reported as the type of income that they are. So I wanted to give you a kind of a zoomed out view of where on this form you would expect to see entries and where on the form you would expect to see entries that we might be sending our client on to a page preparer. I also want to point out before we look at those specific boxes that there's a Part 1, a Part 2, and a Part 3 to this form. So Part 1 gives information about the partnership, you know, the name, its ID number, because again, the IRS is matching what the partnership has reported as income to the IRS already to what the actual partner is reporting on their return. And Part 2 gives information about the partner. It gives information about whether that partner is actively or passively participating. It gives information about whether they are at risk, considered at risk, all of their investment into the partnership is at risk. Or it also covers the partner's basis, which is really important to the partners. We don't necessarily report that on the 1040, but the partners need to be tracking their basis if they were ever to sell their interest in that partnership or the partnership closed down. They would be wanting to subtract their basis from the proceeds to report their taxes in that year. And of course, that's beyond the scope of what we will be handling, but we need to be able to advise our taxpayers that they need to hang on to this form and be tracking that. That's really important. So the specific boxes that we're interested in are box 5 for interest income, box 6A is dividend income, 6B is qualified dividends income. We also cover box 20, code Z. Box 20 is a box that you might see several different things in there, and with codes similar to, you know, our W2 box 12s. But the only code that we will be handling is section 199A dividends, and that's code Z. Box 8 is for net short-term capital gains and losses, and box 9A is for net long-term capital gains and losses. Box 18 is another one of those boxes that will have multiple code possibilities. The only code that we will be working with in that box is for tax-exempt interest income, and that's code A. And then box 7 is our royalty income, and it's the one time that as advanced volunteers we would be seeing a Schedule E on our client's return. So here's the K-1 for the 1120S, or our S Corporation shareholders. And you'll notice that our boxes of interest and at least one of our codes moved around a bit. So this time we're looking for interest income in box 4. Boxes 5A and 5B are dividends and qualified dividends respectively. Box 17, code V, is what we would expect for our 199A dividends. Box 7 is for the net short-term capital gains and losses, and box 8A is the net long-term capital gains and losses. In box 16, we have code A for tax-exempt interest income, and box 7 will be that royalty income. And lastly, here is our K-1 for the Form 1041, which is estates and trusts. So this is typically comes into play when somebody had a family member pass away and all of that family member's assets and stuff went into an estate or a trust, depending on how they did their financial planning. So once that flows into that estate or trust, the estate and trust keeps track of any income items that might have occurred and distributes that according to the people who have a share in that income or the deductions or credits. So here you can see that we've moved around quite a bit in the boxes that we're interested in. So this time it's box 1 is interest income, 2A and 2B for dividends and qualified dividends. Box 14, code I, is for those 199A dividends. Box 3 is net short-term capital gains and losses. 4A is net long-term capital gains and losses. Box 14A is tax-exempt interest income, and box 5 is royalty income. And then because we do have boxes that could possibly have all kinds of codes, and you might not in the field remember exactly which are the codes that we handle. K-1 of the Form 1040, page 2, has a list of codes for those boxes. So hopefully our taxpayers have brought this in, but they may not have. So if they didn't bring in that page 2, you can always go to the instructions for Schedule K-1 for the 1041 and look those up. For the K-1s for 1065s and 1120Ss, you have to go to the instructions. They don't have a page 2 any longer. So when you go to the instructions, usually somewhere towards the front there's a link to the end, or you just scroll to the end and the list of codes will be there at the end. So unlike the W-2s or the 1099 Rs or other 1099s, the Schedule K-1s are not filed with the tax return. So, the IRS wouldn't be expecting to get a copy of the K-1 with the taxpayer's return. The partnership or other entity already filed with their informational return a Schedule K-1 for the partner. But the partner or shareholder needs to keep that K-1, as we said before. It carries important information regarding their basis or their holdings in that entity. And then just as the K-1, Forms K-1 had entry for royalties, there's one other form that we can report royalties from, and that's the 1099 miscellaneous, and you see box 2 there. It's important that you're making note that only royalties that are reported without any associated expenses are in scope for the VITA program. So if somebody is bringing in this 1099 miscellaneous and they have expenses that aren't reported on this form, they would be with the taxpayer's records. We would need to send that person to a paid preparer. And as I briefly mentioned before, royalty income will generate, or when you enter it into TaxSlayer generates a Schedule E for that 1040 return. And that Schedule E is supplemental income and losses. It reports several different things like rental real estate income, the royalties. It could report information on income from partnerships or S corporations, their ordinary income, which is out of scope for our program. We just have those several different kinds of income that we can report, not the partnership or S corporation's ordinary income. And you can see here there's box 1B, and it has several slots there in A, B, and C, again, because taxpayers may have more than one entity that they're reporting for. So A would be one entity, B would be another entity, and C another entity or activity. And then there's a list on the form of some codes or types of entities. For the royalty income, you select type 6 and you would enter it into that box 1B. And then you see in the grid below, there's space for the income, and then line 4 is royalty received, and then you have columns that are associated with the rows from that box 1B. So you'd be expecting to see a number in 1B, between 1 and 8, and you'd be expecting to see that royalty income flow in onto that grid. And we'll talk a little bit more about rental income, even though it's going to be out of scope for our program, just as an awareness thing. But you'll notice below that line where the income gets reported from royalties, the line above would be rents received. And then there's a whole list of lines below that are for rental expenses. And then there's a page 2 to this. I didn't put a copy of that on here because, again, if you're seeing page 2 of Schedule E with stuff on it, you know that you want to go back and figure out where the entry is that is generating that. It would not be in the correct spot. You should only be seeing entries where those yellow, the box with the yellow highlight is for an advanced return. So on to rental income. And again, we are really just mostly covering this as an awareness thing. It's important that generally a payment that's received for renting a room or a home to a tenant is rental income, and it's reportable on the 1040 Schedule E. So if somebody has had a situation where they're actually renting out a room in their house, they should be reporting that as rental income. Now, people do live together in cohabiting situations, or they might be in an expense sharing situation, and that's not the same as renting. But where one person has the ownership of the property and is receiving rent from another person for that room, even if the even if the person who's now essentially a landlord is living in that same house. If they are getting rent and it's not an expense sharing situation, then they need to report rental income, which means that we would be sending that person on to a paid preparer. So if that does come up in conversation, you do your best in your interview to determine, is this expense sharing or is this rental income? And based on that, we may or may not be able to prepare that client's return. However, there is a funny little carve out in the code where taxpayers are not required to report income and expenses if they rented their personal home for less than 15 days. So, say they went on vacation and they had somebody come in and just rent their house as a vacation rental or something for less than 15 days, they don't need to report that income. It's not taxable. And the expenses, they don't need to report the associated expenses with that. And of course, they shouldn't, because the income itself is not taxable. So as an advanced preparer, you are able to handle this sort of situation if they rented their home, their personal residence out for less than 15 days, because it doesn't end up on the return at all. And then if anybody rented their personal property, so if they had equipment or vehicles that they were renting out to other people, that will be out of scope entirely for the VITA and TCE programs. And the slides that are coming up next, again, we're just kind of looking at them for informational purposes to kind of see how rental income works from a very high level perspective. Rental income can be very complicated, and so it's mostly out of scope for VITA. The only people that could possibly have their returns done are, again, those military, active duty military personnel who are renting out their personal residence while they're away and on duty. And so this requires military certification. So anything after this point would require a military certification in order to prepare. So here again is our Schedule E, looking more specifically at rental income. You can see in box 1B, we're still needing to put in some sort of a code to describe what kind of property it is. Was it a single family residence? Was it a multifamily residence? There's some other types there that are listed but would be out of scope for the VITA program entirely. And then you can see in line 3, there's your space for rents received, and then lines 5 through 20 are various types of expenses. And then there's some calculation lines and lines down at the bottom that come in from other parts of the Schedule E, and then they total up. So rental income can include advanced rent. So if our taxpayers received cash for rent, they need to report that on their return. That includes security deposits if it represents rental income. And what that means is if the renter is able to get that deposit back, it's considered a deposit and not rental income. However, if that amount of deposit was really like for first and last month's rent, that's considered rental income, and it needs to be reported when it is received. At least for our taxpayers who are having the cash method. And when I say our taxpayers, I mean military taxpayers with a preparer who has military certification. So payments for breaking a lease is also considered rental income. If the tenant paid any expenses for the rental, that's rental income to the landlord. And fair market value of any property or services received instead of rental payments. Again, bartering is just generally out of scope for the VITA program because it's a little more complicated in figuring out what the fair market value of those property or services is. But outside of that, taxpayers still have to report that as income. And then we can look at the rental expenses, and we're going to divide these into two different kinds of expenses because specifically the types of renters that would be in scope for the military certification will probably, it's their personal residence that they're renting out, and so they're going to have some expenses that they get to fully deduct and some expenses that they might need to allocate between their personal expenses and what can be fairly expensed for the rental on Schedule E. So generally speaking, these are expenses that you might expect to be direct expenses, but anytime you have a client, you have to use your interview skills and determine whether they are accurately direct expenses, especially for a couple of these. So advertising is generally going to be a direct expense. Auto and travel expenses to check on the property or collect rents. Commissions paid for collecting rental income, legal and professional fees that are associated with the rental property, and then repairs to the rental area and cleaning and maintenance of the rental area. Again, if it's for that rental area, then it would be direct. If it's an expense that kind of covered the whole home, then you might be looking at an indirect expense that needs to be allocated. And then there are other rental related expenses such as the rental of equipment or long distance phone calls to conduct business for this rental. And here are the expenses that could possibly be considered indirect expenses if the taxpayer is living in this home, a portion of this home, or they lived in the home for a portion of the year and rented it for a portion of the year. So things like insurance premiums, mortgage points, mortgage interest, and property taxes and utilities may have a calculation involved where part of those expenses can flow onto Schedule E. Some of those expenses might need to flow onto Schedule A as itemized deductions, and some of those expenses wouldn't be deductible as personal expenses at all. So you would have a portion go to Schedule E and the other portion would not be on the taxpayer's return because it's not deductible. So the allocation of these expenses can be based on a ratio of days. So it would be like the rental days to the total days in the year. And personal days, the expenses, those indirect expenses, would go to Schedule A if they were deductible kinds of expenses. And we'll be having our itemized deduction lesson a little bit later, so you'll be aware of what those are in a little bit. If those expenses occurred for rental days, you would be allocating the portion of those expenses that belongs to those rental days to the Schedule E, and they would appear here on this grid, those lines 5 through 19 somewhere. Another way to allocate rental expenses would be what rental square footage to the total home square footage. So this occurs in the case where you have a taxpayer who is just renting out one room of their home. And again, whatever expenses are allocated to the personal use of that space, if they are deductible on the return as itemized deductions, they would go to Schedule A. If they are allocable to the rental space, then they go to Schedule E. So those are our indirect expenses. And remember that anything that's directly for that space, if there were repairs that were specifically for that rental space, then those are fully deductible in addition to any indirect expenses. And then I just want to point out that repairs to a taxpayer's personal residence are not going to be deductible. That's not something that can be deducted on a Schedule A itemized deduction. Repairs to the rental space, however, are deductible on the Schedule E. And then we need to talk about the difference between repairs versus improvements. And for those of you who are not familiar with accounting rules and you're new to tax and accounting generally, this can be a little bit confusing at first. For those of you who have done some accounting classes, this will sound very familiar, but of course in the field, sometimes it's not super easy to tell, and so we use our resources to look stuff up, and we use our judgment to determine whether this expense is a repair or an improvement. So an expense comes with repairs. Those are things that are part of the regular upkeep of the underlying asset or property. In this case, it's a rental. So things like painting, fixing gutters, repairing driveways, replacing window glass, repairing the roof, or repairing appliances. Those are all things that are considered expenses. You would expect to have them, these things kind of ordinarily wearing down and needing just some regular upkeep, or they affect a small portion of the overall asset. Like for instance, with window glass, it's a small portion of that overall house. Improvements, on the other hand, tend to be much larger. They often extend the life of the asset, or they enhance it in some way. So things like adding a room enhances the overall property, right? It kind of changes the nature of it now that it has a new room. So that would be considered an improvement. Installing a new fence is considered an improvement. Putting in plumbing or wiring, these are very big kind of changes to that house. Replacing the hot water tank, putting on a new roof, or replacing or adding major appliances. And this is important because improvements don't get to be expensed all at once. The taxpayer has to depreciate them over time, so they're going to recognize those expenses over the course of multiple years and not all at once on this return. Repairs, on the other hand, the taxpayer would be taking all at once on this return. And then depreciation is another one of those expenses that would get allocated based on, the rental space to the total space or the rental days to the total days. And taxpayers are expected to take depreciation on business property. They must take depreciation. This can run some taxpayers into trouble if they don't realize that they're supposed to be taking depreciation, because when they go to sell the home, there's something called a depreciation recapture, and they might find that they owe more money. They have to recognize gains on that sale that they weren't expecting to have to recognize, and they might think, well, I didn't take all this depreciation, but it doesn't matter because it's allowed or allowable depreciation that has to be, recaptured, that increases the gain when the taxpayer sells. So they definitely want to be taking their depreciation as they go, so they get the tax benefits of that, because they're going to have that recapture regardless of whether they historically took the depreciation or not. And then, of course, depreciation is not deductible as a personal expense at all. So this is another one where if somebody is, allocating a portion of the home or a portion of the time to the rental space, then you'll see, the part that's associated with that rental on the Schedule E, and you won't see any personal expense associated for depreciation. So to appropriately calculate depreciation, which if you're entering into TaxSlayer is going to do this, but just as an understanding the concept, you have to have basis, you have to know what is the value that you are depreciating, that you're taking this expense over time, over several years. You need to know what kind of method the taxpayer is using. There are several methods. I'm not going to go over all of them. I'll just show you the most common one for rentals. Convention, which is at what point do we start calculating depreciation based on whenever this house was placed into service as a rental. And we need to know the recovery life. How long are we going to be taking this expense bit by bit over how many years in the case of a rental? So we talked a little bit about basis in our last lesson on capital gains and losses. So we should be a little bit familiar with the idea of adjusted basis. For a rental, the basis for depreciation is the lesser of that adjusted basis, like we talked about, or the fair market value of the property when it was placed into service. And it's really important to make sure that you are taking out the value of the land, because land does not depreciate. So just the building or the portion of the building, and if there are items inside that building, appliances that depreciate, those are things that can depreciate, but land will never depreciate. And then here is an example. It's the most common example of what you are going to see with rental of a personal residence, for the convention, the method, and the life. So generally speaking, you're going to see properties that use the modified accelerated cost recovery system as the method of depreciation, and they're going to use straight line for a building. So they're just taking the total amount of the basis and evenly distributing it out over In the case of a residential rental property, 27 and a half years. And the mid-month convention says that whatever month the taxpayer put this property into service, you're just going to use depreciation like as if they put it into service at the middle of the month. And there are tables the IRS puts out that help you understand how much depreciation you'll be taking, depending on where in the depreciation process this piece of property is. Now, it's important to note too that this is for the building, which is again what you're most likely going to see in the case of somebody renting out their house, but appliances can be depreciated at a much faster rate as well. But as I said, there's a lot of different ways to depreciate and different rules around depreciation for tax, and that is why it is generally out of scope for VITA, except for this very one special circumstance, and even that is quite limited when you have the military certification. And then it's not uncommon for rentals to generate a loss for the taxpayer. So there's some rules around whether or not the taxpayer can take that loss, or will it be limited. There's an at-risk rule, so the taxpayer needs to be at risk of losing their investment if something were to go wrong, in order for them to be able to claim any of these losses. And then there's passive activity rules, which also can determine how much the taxpayer can take in losses. So generally, passive losses are limited to passive income. And generally, rental income is considered a passive type of income. Royalties are another passive type of income. Your active types of income are like your wages and your interest, things that the taxpayer is actively pursuing. They're doing things during their, the course of their days to get this income. And passive income is more like, it's happening in the background and money is just coming in. So there is an exception to the rule that rental income is considered passive. It allows for taxpayers who actively participate in the rental activity, and this is not somebody who is actively participating as like a business. They're in the real estate business. That's different. That's active participation, but that's different than what we're talking about with this rule. So this rule is, more applicable to, probably most of your small landlords who, maybe they own one or two properties that they're renting out, or like I say, for the VITA program, it's very specific. So the exception allows taxpayers who actively participate in the rental activity to use up to $25,000 in rental losses to offset non-passive income. So it would be possible for them to generate up to $25,000 worth of loss, and that could lower their things like wages by that $25,000. If they're limited, then they end up carrying those losses forward until they have more passive income that they can use those losses against. And then we kind of need to understand what active participation means. Active participation in the case of a rental means that the owner owns at least 10% of this rental property. They are making management decisions in a significant bona fide sense. And what that means is, are they approving new tenants? Are they deciding on rental terms? Are they approving expenditures and similar decisions? They are allowed to hire a management company for, things like getting repairs done and stuff like that. But are they actively engaged in, making sure that those decisions are in accordance with what they want? So that is what it means to actively participate in a rental property.